Now, if you have been following this investing guide series, by now you will have understood the importance of building your financial foundation and understanding the investment accounts that you can put your investment inside, which I have covered in steps 1 and 2 in my previous video. If you have not seen the video yet, it is showing on your screen right now. The next step after watching that video now is, what can I invest in, or what can you invest in? Stocks aren't just one thing. There are different ways to invest in them, and each of them have their own risk level, their costs, and their level of involvement. As a beginner, it's important to choose an investment type that matches your goals, your budget, your comfort level. And in this section, I'll be breaking down the main types of stock investments that you'll come across, like individual stocks, mutual funds, ETFs, index funds. Don't worry, I'll cover this shortly. And I will help you understand how they work and which ones are beginner friendly. By the end, you have the clarity to decide what type of stock investments to start with and avoid common mistakes new investors make by jumping in blindly. Now, before I start, please take a moment to like, subscribe, and share this video with your friends and family, and even enemies, as I usually say. This is a new channel. Your support is much appreciated. Let's dive right into the main types of stock investments that new investors should learn are as follows. Number 1 is stocks and shares. What is it? Now, when you buy a stock, you are buying a piece of a company, usually a small piece or part of the company. If the company does well, the value of your piece goes up as well. If the company does not do well, the value of your piece goes down. Now, the catch here, or the issue here, is that it could be risky because your money depends on the performance of one company. I always give the example of BlackBerry. Nobody ever thought BlackBerry would be where it is today, but see what happened. Anybody that invested their money in just that stock would have lost their money by now. That is the risk that comes with investing in one company. Now, to address this risk, we have different options. The options include mutual funds, index funds, ETFs. Now, the aim, what funds do is that they invest in multiple companies to ensure diversification. So take the fund like a basket, and then the basket contains several stock investments, and there are different types. So the first one I'll be talking about is mutual funds. A mutual fund will collect money and pull money from several people, which includes you. Now, the manager of this mutual fund will research and pick several stock investments to buy on you guys' behalf, so that you don't have to do it yourself. It will then use the money that you collected and pulled from you and other people to buy these stocks or these investments. So, in essence, a variety of stocks will be bought in the fund. Just think of it, like I said before, like a basket that contains multiple stocks. It comes with higher fees for this reason, because they have to research and do more work to get the stocks. Now, the fees on a mutual fund are usually in the range of around 1.5% to 2.5% of investments under management. So your total assets, your total investment, they will be taking that amount every year for fees, which in my opinion is quite expensive and can eat significantly into your return over time. Which brings me to the next type, index funds. Index funds are like mutual funds, same thing, basket of stocks, everything, but they copy the performance of a benchmark or an index. So somebody will say, which one is benchmark, which one is index? So let me explain. A good example of an index or benchmark is the S&P 500, which simply means 500 of the biggest companies in the US by market value. These companies include Amazon, Apple, Tesla, all of them. So a fund that tracks the performance of this S&P 500 index will produce a return that is similar to the average performance of all the companies that are listed in this index that you're looking at on the screen right now. So obviously, 500 companies is less risky than one company, obviously. And because there are multiple companies in one fund, if some companies are doing badly, other companies are doing well, raising the overall average performance of the fund and making it okay to invest in. Another thing to consider with index funds is that the fees are lower compared to mutual funds. That is because the fund manager does not have to be picking stocks, unlike mutual funds where he has to research and pick stocks on your behalf. This one, it just takes everything in the S&P 500 and invests inside it. So the fees are usually in the range of 0.3% to 1% of your total investment under management compared to mutual funds, which is way cheaper. Based on this, index funds can be really good for beginners. It's a hands-off approach. You don't have to stress yourself, and the fund manager is not charging you so much because you're not doing so much compared to a mutual fund. However, even though index funds are good for beginners, it is not as flexible for trading as the next option on the list, called exchange traded funds. It's basically like index funds that are traded on an exchange. That is the summary. So like index fund, they also hold multiple stocks at once, often tracking an index, it's a basket of stocks in one investment. As usual, that's what the fund is. I'm repeating it over time so it sticks. Now, this basket of stocks, unlike the other ones that are not easy to trade, is trading on the stock market the same way one stock will be trading. So you can buy and sell this basket of stocks the same way you will buy and sell one stock, which means it is extremely flexible to trade. Because of this, again, like index funds, they also have low fees. They are very diversified, very beginner friendly, easy to buy and sell. So the fees are very low. The fees are usually in the range of 0.03% to 0.75% per year of your total investments under management. Let me quickly recap why beginners love ETFs and why I'm a big fan myself of ETFs. It's easy to buy and sell like a regular stock. It gives you instant diversification. So you buy one ETF, it gives you exposure to several hundreds of companies easily. It is low cost, low fees than mutual funds. Mutual funds eat into returns over time. Then you don't need to be an expert because you're just buying something that tracks the entire market. You don't have strength. You just buy what you want to buy and move on. Many ETFs just follow an entire market. And it's flexible. You can start with small amounts and grow over time. You can invest as small as $50, $100. Any amount is fine. There's a table here that I'm looking at on the screen right now. It provides a summary of all the different types, from stocks, mutual funds, index funds, and ETFs, just in case you need a full summary. So take your time. Feel free to pause this video at this point if you need to take a look at that table to have a holistic picture of the stock types that you can choose. Now that you understand the different types of investments and know why ETFs, in my opinion, are a good starting point for most beginners, it's time for me to go a bit deeper into ETFs. You might be wondering, so after all this coverage now, which ETF should I buy exactly? That's a good question. And this is where many people kind of get stuck. There are hundreds of ETFs in Canada / the US, but you don't need to look at all of them. In fact, you can build long-term wealth by consistently investing in just one or two solid ETFs that match your goals and risk level. In this section, let me quickly just break down a few of the most popular beginner-friendly ETFs that are used by thousands of Canadians. These are the kind of investment that you can just set and you can just forget, and they will give you exposure to hundreds of companies with ease. So I'm going to explain what each ETF invests in, what kind of investor it is best for, how much risk and return you can expect over the long term considering past performances of these ETFs, and why the ETFs are ideal for simple long-term investing. I'll be saying a lot of abbreviations, but don't worry, I'll clarify it in plain language. So as I'm saying the abbreviation, I'll be telling you what the abbreviation means and I'll be explaining it. So let me start with the first one on the list, VFV. VFV stands for Vanguard S&P 500 Index Fund. The company that provides this ETF investment is Vanguard Canada, and is one of the largest investment management companies in the world, along with another company called BlackRock and State Street. All those other companies also have their own ETF products. Now, what does this ETF invest in? It's like buying a basket that contains 500 of the largest US companies, which includes Apple, Amazon, Google, Tesla, etc., etc. Why is it good? It gives you access to the US economy and top performing global brands at once. And this thing is good for beginners that want to invest in the US market with low fees. Risk level is moderate because it depends on the US market performance. The growth potential is also very high because over the long term it tends to perform very well. It has an average annualized return of 10% based on past performance. I personally have VFV in my own portfolio. The second one on my list is VGRO, which is Vanguard Growth ETF Portfolio. The provider company again is Vanguard Canada. So what does it invest in? It has a mix of about 80% stocks in Canada, US and international, and then 20% bonds. If you don't know what bonds are basically you lending money to maybe the government or to corporations. It's much safer than stocks. So to balance the risk in these ETFs, they added some bonds, which is 20% of the entire portfolio. Why is it good? It's also good for long-term growth, and it has some bond protection, like I mentioned, to reduce volatility. It is good for investors that want global exposure. If you have a long-term approach to all of these ETFs, to be honest with you, the risk is just moderate. It's okay. Third one we have is VBAL. That's the Vanguard Balanced ETF Portfolio. Vanguard also provides this as well. What does it invest in? A mix of 50% stocks and 50% bonds from Canada, US, and international markets. It's a safer option with steady growth and less risk. Now, if you're someone who is a conservative investor, the risk level is also considered moderate but more stable. The last one on my list is XCQT, which is the iShares All Equity ETF portfolio. Now, the provider of this one is BlackRock Canada. Now, what does this invest in? A 100% stock portfolio diversified across Canada, US, international markets. It's basically like a morph of VFV, but this one is exposed. It gives you international exposure, not just exposure to one country, which is the US for VFV. This one gives you exposure to different countries, and there are no bonds involved, only stocks. Go for long-term investors that are okay with risk. They have a long-term view. They understand that investing requires patience, so they have like a 20-year outlook, 30-year outlook, and they are going to allow their money grow, and they're not going to withdraw it. Those are the people that this ETF is good for. Now, XCQT and the first one, VFV, in my opinion, are a very good starting point if you have a long-term view, 20 years, 30 years, 40 years. The historical returns of these ETFs are indicated on the table you're looking at on the screen right now. Please understand that these examples that I have given are just examples of good ETFs. If you want to choose, you have to do your own research. But this is just to give you an idea and an understanding of how ETFs work. And if you want to choose any of these, do more research before you choose it. This video is for educational purposes only. Now, the last thing I want to talk about, if you're looking at the returns on these ETFs, is that there is something called the average annual return, which really means that just the same way stocks work, the ETF can go up 15% in 1 year, it can go down 5% in another year, it can go up 10% in another year. Stocks and stock investments are very volatile in the short term, but in the long term, it tends to be more predictable because businesses have to adjust their prices for inflation anyway. The businesses are going to be more profitable as time goes on. And this is why it is important to invest for the long term and not panic when the market is going down and going up temporarily. Just ignore it completely. Take like $200 or $100 from your money, or any amount of money that you can afford to be putting it into one of these solid ETFs, maybe like VFV or XCQT. Be doing that maybe like every month, and you're putting it consistently, and eventually you'll be well off. 30 years, 40 years investing view. So you're planning, that's how you plan for retirement. If $200 is invested every month and the investment is compounding at an average annualized return of 10% every year, which is what the VFV has done over time. If that person holds on to that investment for 40 years, that is over $1 million. And you can put in more money. And the more money you put, the more returns you make. So you can always increase the amount of money you're investing for the future. However, you can start small. So I'm just letting you know the power of how your investment can compound and increase over time. And you don't even have to do much. You set it, and I'll teach you in the next part of this series. I will show you how to invest using Wealthsimple step by step, how you can set an investment and forget it and be doing it consistently towards retirement. If you got value from this video, please don't forget to give me a thumbs up, subscribe to the channel, share the video with your friends, with your family, with your enemies, with anybody that you know, and let me know what you think in the comments as well. Thank you very much for your time. I'll see you in the next part of this series, which is probably linked right now to the video. Have a nice day.